Welcome back. This week we're going to talk about property classifications. What type of properties are out there? How do we classify them so we make sure we make the right decisions when we choose to invest? So how do we classify properties? Apartment buildings are classified in A, B, C, and D categories. And the classification is determined by the age, the amenity, physical conditions, and also typically the area they're located in. And locations are then classified as A to D based on crime rate, walkability, proximity to shopping, dining, transport, and other amenities in the community. Schools is another important aspect of the location classification. Class A properties have the following characteristics. They're newer constructions, typically less than 15 years old, similar to the picture you see in the background here. They have top amenities such as gyms, pools, tennis courts, or other things. Their tenants are typically high-income earners. They're tenants by choice. They actually choose to rent versus buying a house. The properties typically have low vacancy rates. It's in a desirable location with easy access to shopping and dining and so forth. The buildings typically have little or no deferred maintenance. They've been kept well, and the current owners have really done a good job keeping them up to date. The returns in these Class A are typically fairly low. I've currently seen that you may get 4% annual return or something like that. But what happens is big pension firms and REITs are pouring billions of dollars into these types of properties because they see them as low risk, and they are happy with these lower returns. And it's also, considered a safer investment because of the quality of the property and the tenants. Class B apartment buildings have the following characteristics. They're older construction, 15 to 30 years old. They may have some amenities. They're typically mid-income earners. They could be tenants by choice or by necessity. By necessity, I mean people, they actually don't have the credit or the money to buy their own house. The vacancy rates are typically, what's common for that market region. They can be in a decent location, not in the greatest, but also not in the tougher areas. They may have some deferred maintenance issues. Maybe they need new roofs or windows and stuff, and can have good returns if renovation can result in higher rents. There's obviously some risk, but also some upside. Class C is kind of the value add proposition for a lot of investors. Older constructions, more than 20, maybe 30 years old. They have typically no or few amenities, or if the amenities exist, they're pretty run down, like an old pool or a club room that hasn't been maintained for many years. Typically, mid to low income earners, typically tenants by necessity. The vacancy rates are, market or maybe a little bit higher depending on the management. This is not necessarily the best location. Sometimes it's away from the city centers or it's in the suburbs or other areas, but not also the worst locations. There could be some significant deferred maintenance issues, roofs, windows, parking lots that need to be taken care of. But these are also the types of properties that we really try to focus on because they have the best option for returns. If you look at a property like this and the units haven't been upgraded for 20 years and it's a little bit dated, but you get it at a decent price, if you can go in and renovate the units, raise the rent, you're going to see a very good return on your investment. So these are kind of the type of properties that we like to look for. It is a riskier investment because you want to make sure that your business plan actually can come to fruition. So go in there with good understanding of what the amount of work that's required to bring these units up to a higher standard. So Class D properties are very old construction, 30, 40, 50 years. Maybe not quite as bad as the picture I'm showing in the background, but that just gives you an idea of a very poor building. Typically no amenities, very low income earning tenants, and high vacancy rates, really expensive turnovers because the tenants don't tend to take very good care of the property. It's typically in a poor location, high crime, war zone area, if you will. Typically major deferred maintenance issues because their owners have just not seen any value in putting money back into these properties. They can have great returns if you have good management that understand how to manage these types of properties and tenants. But just realize there's really no exit strategy in the sense that you're unlikely to be able to raise the value in the property. So the only reason why you want to do this is a high risk, good cash flow type investment. So this is not for the faint of heart, and I would not recommend going into a Class D property unless you really know what you're doing and you have a very clear strategy for how you're going to manage it. So when it comes to the actual areas, they can also be classified from A to D. So Class A neighborhood, is near downtown, great community, great amenity, awesome schools, just, wonderfully place to live. And typically attracts the high income earners that want to pay that premium to live close to these amenities. Class B neighborhoods are more, your decent area, some amenity, kind of a family focused area. Not too bad, but also not the, greatest amenities there. Class C, lower income, kind of working class neighborhoods, few amenities, a little bit further to transport, to restaurants and shopping. And then we come into the Class D, which is really, your high crime, very poor neighborhoods, war zone type areas that are very challenging and should not be attempted by the beginning investor. So where should you invest? Well, it really depends on your goals. And a couple of webinars ago, I talked about determining your goals and figuring out what you're trying to achieve with real estate investing. So, we really like Class B and C with some value add. So if we can get, a nice Class B property, good location that just needs some work, a little bit tired, or even a Class C in a decent neighborhood that we can upgrade and turn it into a Class B, that's really where the bread and butter is in our type of investing. That's really where the good returns are. You all have a steady supply of tenants because of the lack of affordable housing and so forth. So that's our focus area. Just need to understand what you're getting into. The property, the location. Don't go in there with blinders on. Really get all the opinions from the brokers, from people who live in the neighborhood, from the property managers, and say, what am I getting myself into here? Is this a good neighborhood, a good investment, or am I going to face some challenges down the road that's going to eat into my profits? So I'd like to offer anybody that's interested a free call. Just go to my website, opendoorscapital.com/call, and schedule a session with me. I love to talk about real estate or anything else. I enjoy outdoors, cycling, and anything else. So whatever you want to talk to me, please sign up for a free call and we can talk about what you're trying to achieve. Thank you for listening. I hope that this webinar provided some valuable information. Next week, we're going to talk about key financial metrics. How do you evaluate a property versus to see if that's a good investment? So stay tuned. Let me know if you have any questions, comments, or anything. My email is jens@opendoorscapital.com and my website is opendoorscapital.com. Thanks again.